The question hanging over the entire tech and investing world right now is a simple one with monumental implications. We've watched companies like Apple, Microsoft, and Amazon cross the once unthinkable threshold of a $1 trillion market valuation. These are the titans of the modern economy. And now, with the artificial intelligence revolution accelerating at a breathtaking pace, all eyes have turned to the company supplying the fundamental building blocks of that revolution. Is Nvidia positioned to join that exclusive club? Is it the next trillion-dollar stock? It's easy to get caught up in the hype, to look at the explosive growth and the dominant market position, and just assume the answer is yes. But in the world of investing, assumptions are dangerous. Getting to $1 trillion isn't about sentiment or story. It's a cold, hard math problem. It's about revenue, earnings, growth rates, and market size. Today, we're going to move beyond the headlines and perform that math. We're going to break down exactly what it would take for Nvidia to reach a $1 trillion market cap, examining the potential pathways, the formidable obstacles, and the realistic timeline. This isn't about cheerleading or fear-mongering. It's about a clear-eyed analysis of one of the most compelling investment narratives of our time. First, we need to establish the baseline. Let's talk about what a $1 trillion valuation actually means. As of our recording in 2025, Nvidia's market cap has seen incredible growth, but the journey to $1 trillion is a specific mathematical journey. The market cap is simply the share price multiplied by the total number of outstanding shares. To reach $1 trillion, Nvidia's valuation would need to increase substantially from its current level. But how does a company justify such a massive valuation? It all comes down to its profits and its growth potential. The stock market values companies based on their future earnings, discounted back to today's dollars. So, for Nvidia to be worth $1 trillion, investors collectively have to believe that the company's future profits, its net income, will be large enough and grow fast enough to support that price tag. This is typically measured by the price-to-earnings ratio, or PE ratio. If a company has a PE ratio of 25, that means the market is willing to pay $25 for every $1 of its annual earnings. To justify $1 trillion valuation, you need a combination of sky-high earnings and a market willing to pay a premium for those earnings based on future growth prospects. For a company in a hyper-growth phase like Nvidia, the market often tolerates very high PE ratios because it expects those earnings to grow rapidly, effectively bringing the ratio down over time. The entire thesis for Nvidia becoming $1 trillion company rests on this expectation that its current explosive earnings growth is not a temporary spike, but the new normal for the foreseeable future. So, what is the growth engine that could possibly fuel this ascent? The first and most significant is the sheer size of the total addressable market, or TAM, for AI chips. We are in the very early innings of the global AI transformation. This isn't just about chatbots and image generators. AI is being embedded into every single industry: healthcare for drug discovery, finance for fraud detection and algorithmic trading, automotive for self-driving systems, manufacturing for predictive maintenance. The demand for computational power is insatiable and global. Analysts project the data center AI chip market alone could grow to well over $100 billion annually within a few years. CUDA and its entire software stack create a sticky ecosystem that locks in customers. Migrating to a competitor isn't just a matter of swapping hardware. It's a costly and complex retooling of entire software pipelines. The third pillar is strategic expansion. Nvidia isn't just selling discrete chips anymore. They are selling entire systems, their DGX supercomputers, their HGX platform. They are pushing into the automotive sector with drive platforms and into the omniverse for industrial digitalization. Each of these moves expands their TAM and moves them higher up the value chain, allowing them to capture more dollars per customer. The single biggest headwind is competition. The current gold rush level demand has, for the moment, obscured the fact that every other major tech company is gunning for Nvidia's lunch. AMD is rapidly improving its MI300 and MI350 series with its ROCm software stack. More dangerously, Nvidia's largest customers, Google, Amazon, Microsoft, and Meta, are all developing their own custom AI chips, known as application-specific integrated circuits, or ASICs. While these may not replace Nvidia entirely, they will almost certainly be used for specific, large-scale inference workloads, chipping away at the potential market and, crucially, reducing the pricing power Nvidia can wield. The second major challenge is the cyclicality of the semiconductor industry. We are currently in a historic boom cycle, but history shows that booms are often followed by busts, or at least significant corrections. When the hyperscale cloud providers finish their initial AI infrastructure build-out, demand could plateau or even contract as they digest their capacity. The stock market is forward-looking, and if investors see signs of this growth slowing, the valuation multiple will compress dramatically, making the path to $1 trillion much longer and more difficult. The third challenge is execution. $1 trillion valuation requires flawless execution quarter after quarter. Any misstep, a delayed product launch, a manufacturing yield issue, a security flaw in their software could shatter the narrative of invincibility and trigger a significant sell-off. The company is operating at a scale and complexity that is unprecedented in its history, and the margin for error is razor thin. Let's talk about the math and the timeline. Reaching $1 trillion requires Nvidia to not only maintain its current astronomical growth, but to do so for several more years. It requires that the AI adoption curve continues its steep upward trajectory without any major slowdowns. It requires that competitors, both traditional and internal, fail to meaningfully erode its market share or pricing. And it requires that the global economy remains relatively stable, avoiding a deep recession that would cause corporations to slash their IT and AI budgets. The timeline is highly speculative. If growth continues at its current scorching pace and the market maintains a high earnings multiple, it could happen within the next few years. However, if growth moderates to a more sustainable but still impressive rate, or if the P/E ratio contracts as the company matures, the journey could take significantly longer. A common mistake investors make is assuming a straight-line projection. The reality is that the path will almost certainly be volatile, with sharp pullbacks and surges along the way. The key is to distinguish between temporary setbacks driven by market sentiment and fundamental, long-term cracks in the investment thesis. So, after weighing the immense opportunity against the formidable risks, what is the final verdict? Is Nvidia the next $1 trillion stock? The honest answer is that it has a credible and compelling shot. The company possesses a rare combination of a dominant market position, a deep and durable competitive moat, exposure to the most transformative technological trend of the decade, and a proven ability to execute. The potential is undoubtedly there, however, it is far from a guaranteed outcome. The landscape is competitive, the industry is cyclical, and the valuation already bakes in a lot of future success. Your call to action is to approach this not as a speculative bet, but as a long-term investment in a high-quality company operating in a volatile sector. Do not invest based on the hype or the fear of missing out. Invest based on your own belief in the longevity of the AI boom and Nvidia's ability to maintain its leadership within it. Conduct your own research, consider the risks we've outlined, and never invest more than you are willing to lose. The journey to $1 trillion will be one of the most watched stories in finance, and it will teach us all a lesson about the value of innovation, the power of ecosystems, and the unpredictable nature of the market.